Good morning. Welcome to Stock Market Today and happy Friday. It's July 17th, 2020, and this is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show. Give you daily stock ideas to consider, and that hits your inbox every trading day before the market opens. So U.S. equities lower on Thursday after solid gains in the prior two sessions. Tech, REITs, and energy lag while utilities and materials outperform. Treasuries were mostly stronger with the curve flattening. The dollar was stronger against the major crosses. Gold closed down 70 basis points. WTI crude settled down 1.1%. As we get to the desk this morning here on a Friday, futures are mixed across the board is how I would call them in early trade. Asian markets were mostly higher overnight, though the gains were moderate, and European markets are mixed as well. Treasuries are unchanged to slightly weaker at the front end of the curve. The dollar is weaker versus the yen and the euro. Gold is up 30 basis points. WTI crude is down 60 basis points to kick us off on the final trading day of the week, where I can only say not yet. There it is. I mean, I'm getting to the point where it's boring, right? It's boring to talk about, but quite simply, this is the range. There's nothing we can do about it. The market doesn't care that I'm bored with talking about the range because the market's in the range and it doesn't care. We know where support is. We know where resistance is. We know what that means as long as support is holding. Now, this week, we've kind of gone through breadth divergences. We've gone through positioning. We've gone through sentiment as to why I think that we could potentially see a pullback to the bottom of the range. Maybe we don't get there. That would be a sign of strength. That would be outstanding. But that's nuance. Bigger picture, my view remains the same. As long as support is holding, which it is, the February highs are in play. A break of 3,000. We have to start to think about a different scenario. We do still have the divergences in play. We're overbought based on the 13-period CCI. Chaikin money flow is bullish, but also diverging, right? So nothing's changed. We're at the top of the range. We're pushing on a string. Right? Even this morning, the market is resilient, right? It's had reason to go down. It hasn't. Netflix report last night, not well received. So equities have reason to fall. They're not. So that's an encouraging sign in the near term. We'll see how it plays out. But big picture, the song remains the same. What about our market in a minute? What are we writing about? Well, we're churning in the range. Tech and growth lag again as rotation continues. Today, we're going to spend a lot of time talking about why I don't think that rotation is an enduring theme, i.e. growth over value is rolling over. We do have a mixed message from our risk themes. That's more fodder for inside of our note. The dollar's at a key level, which I think is important, and futures point to a higher/mixed open today. Looking at the major indices from a power bar perspective here, the Dow down 50 basis points yesterday. It's kind of uniform across the board, really. 50, 30, 76. I mean, okay. It was kind of a ho-hum day. 6-6 bulls to bears on the Dow after losing 50 basis points. S&P 500 down 30 bips. 136 to 90 bulls to bears there. NASDAQ, slight underperformer again on the day. Right, part of that rotation. 38 to 10 bulls to bears. Small caps down 63 basis points, 604 to 284 bulls to bears there. Bonds uptick, sending yields lower. Utilities, one of the better performing groups. That's kind of interesting. Take a look at utilities. All right, so yesterday I showed you our screen. Today I pulled one off the screen. I don't believe that we are seeing a secular change to the trend in growth over value. I just don't. I've talked about why. I don't see it. So I want to start identifying growth stocks that are holding up still, that present opportunities, and Box jumped out at me today. BOX is the ticker symbol here. 1846 last, down 3% yesterday. Still has a bullish rating, strong trend, strong industry group. Solid support at $18. breakout level. Right? I should have drawn a line here. I apologize for not. Breakout, holding, running, holding. So far, so good. We're oversold. Money flow's bullish. We're outperforming. We're a bullish stock with solid support. I mean, you have a clear line in the sand. You have a clear level to shoot against, right? It's a pretty compelling trade. You know exactly where you're wrong. And the risk reward sets up even for, you have support. You have support down $0.50, and a rally to the recent highs takes you up $3. It's a pretty compelling trade. That looks interesting to me. Box. In my note today, I'm highlighting the software ETF IGV. Right? If I take a look at the software ETF IGV, it still has a lot more bullish names than bearish names. Okay, IGV has a very bullish ETF rating. It has 34 bullish stocks for only 7 bearish stocks, right? So this growth theme that I still think is there, it's just a pause within it. If I'm looking to start to gain exposure to that, I think I'm paying attention to IGV in a big way, right? 34 bullish stocks there. Let's take a look at our sector tracker now. Movement of the major sectors over the last 5 days. Speaks to the rotation theme, in fairness. Energy at the top of the list, industrials, financials, materials. Those 4 groups are your rotation groups. Those are your cyclical rotation groups. When you hear people talk about cyclical rotation or a rotation into value, generally speaking, that's where they're going. Energy, industrials, financials, and materials. Now, what I've said is I like the materials portion of it. And I actually think it makes sense. Because while I don't think the growth over value trade is over, there are clearly shifts playing out under the surface. So if you wanted to gain some exposure, I think materials is the way to do it. If we start to see inflation, you're going to get paid with materials. You'll also get paid with energy, but energy is still bearish here. Bottom of the list, tech. Real estate also at the bottom of the list. Utes, healthcare, staples, middle of the road. Discretionary, comms, and tech, right? That's been your growth trade. Discretionary, comms, tech, and part of healthcare have been your growth trade. Your value trade is energy, industrials, financials, and utilities. Or not utilities, materials. So there it is. There's your rotation recently. I think we're going to snap back. I think there's a compelling opportunity in the software names. Take a look. Take a look at Box today. I think that's interesting. Our industry in focus, oil and gas, E&P. Yesterday was services, today E&P. I've said this before, I'll say it again. It continues to be my view that if you're going to go bottom fishing in energy, I think E&P is the less train wreck of the two. Over the past 6 months, it's lagged by 35%. Power bar ratio is still weak, 17-9, bears to bulls there. Currently ranked number 18 of 21 subsectors, having moved down 2 slots over the past week. Some of the stocks to pay attention to is potential bearish ideas, Hess, HES, Phillips 66, PSX, and Marathon, MPC, all with very bearish Chaikin power gauge ratings that are holdings in a fund that has a neutral rating, very similar dynamic to what we talked about yesterday. Neutral stock above the trend line, potentially making the turn, but still an underperformer. Bearish money flow, not encouraging. The fund is overbought. If this was a stock, I'd kind of tell you I'd want to avoid it. If you came to me and said, what do you think of XOP? I'd say I want to avoid it, right? Bearish money flow, it's overbought here in the near term. It's lagging, neutral rating. I don't care so much about the neutral rating as long as there's relative strength. There's not relative strength here. So the neutral rating bothers me in that regard. Neutral, underperforming, overbought, bearish money flow. Maybe go sideways. Maybe this is one big base building process. That would be interesting. There will be a time to own energy. I just don't think it's now. You can still draw the downtrend. It's not the most compelling looking chart on the planet. Let's look at what's trending now. Yesterday's S&P 500 movers and shakers, our gainers and losers. We are now in earnings season, and you're going to start to see some shifts around that. So it's going to be interesting. There's going to be less focus on the macro and more focus on the micro. Positive pre-announcement out of Hartford Insurance Group, HIG, sent that stock higher by 4.7%. DR Horton, Up on the housing data that came out yesterday, NAHB data sent DR Horton higher, 4% to the good. PKG caught an upgrade at Bank of America to send it up 4%. Gap caught an upgrade earlier in the week and saw some follow through yesterday, up 4%. And KHC, Kraft Heinz, caught an upgrade. Kraft Heinz very bullish here at Chaikin Analytics. The loser side of the board is interesting because these were all on the winner side of the board the previous day. Norwegian priced an equity offering. Carnival and Royal are down. The CDC extended their no sale order. Additionally, that Moderna drug has questions around it. There was a lot of excitement about the drug, a possible vaccine, right? But the duration of the vaccine in your body has been called into questions. Now, I'm not a scientist. I'm certainly not a doctor, so I follow smart people who focus on this. In particular, I follow smart people who invest, right? Healthcare investors. So a few that I've seen and commented with have pointed out that there's potentially an issue with the duration of the vaccine in the system. So if you think about something like the flu shot, it doesn't stay in your system all year, right? You go back, if you get a flu shot, you go back every year. Picture Moderna's drug being something like that, except you'd have to go 4 times a year, is my understanding. So that's starting to play out. Despite Moderna trading higher, I think the CDC and then some of this Moderna pushback started to weigh on these reopening stocks. So Norwegian, Royal, Carnival, AAL pulled back as well. And then Simon Property Group is actually suing tenants for not paying rent. That's kind of interesting. But that's playing out. It's a very bearish stock. It's trading lower. Fine. Let's get to the growth to value theme. Here it is. This is what everybody's jumping up and down about, right? I would argue that it's not even as severe as what we saw in May. We're still in an uptrend. We're still above the 200-day moving average. The RSI is still holding bullish ranges. Notice in May it didn't become oversold, but it actually dipped. On a relative basis, the Qs are still holding their breakout against SPY. So yes, there's been a rotation in the near term, but that's still very much an uptrend on a relative basis. Core growth against core value. Still very much in an uptrend. It became overbought, and we're working off those overbought conditions. It became a crowded trade, so people need to square up their books. The Qs are rounding out of an overbought position in our overbought oversold indicator. IGV is actually getting close to oversold. All of this is in my note today, by the way. So if you're taking the 14-day trial, I think that that's smart because I go into a deeper dive on all of this stuff. Now, the trade hinges on copper versus gold, which is also at an inflection point. The copper versus gold ratio has been rolling over for 2 years. This is growth slowing. Fourth quarter of last year, around, remember U.S.-China trade talks? Remember the phase 1 trade deal was going to reinvigorate growth? It tried. We got to the 200-day and then rolled over. Notice we rolled over before Corona, by the way. This wasn't, this is Corona. This is before Corona. So we're back at that inflection point. The ratio is overbought based on the RSI. We're at the 200-day moving average. I think that if we fail here, you want to get aggressive with the growth over value theme. If we break out here, I could be wrong. But rates are pinned to the floor, so I don't think we're seeing growth. But we're going to watch the dollar as well for a tell. I think the dollar is important. The dollar is sitting on support at $26. This is UUP. A breakdown would likely be bullish for equities, but bullish for the rotation trade within equities because it will send commodities higher. Materials will rip, energy will rip. Hold support and break higher. Well, then it's just a continuation of the trend that's been in place for the past 2 years. I showed you a short-term dollar here. I should have showed you a longer-term chart. The dollar's been rising since 2018. What happened in 2018? Growth started slowing. Breakout in the dollar resumes the trend. Have a great weekend, everyone. I'm going to be back with you on Monday.